this webinar, we're going to be covering trading pullbacks. And first of all, trading pullbacks is not a long-term trade. It's usually for a weekly trade, a daily trade, or intraday trades, right? So what's important to note is, first of all, if you're going to trade pullbacks, you have to first identify a trend, right? So that ultimately means that pullbacks are not trend reversals. A pullback is basically market going the opposite direction in the short term, but maintaining its long-term direction. What do I mean by that? From the first webinar on price action, we talked about how you would use, say, support and resistance and the 2-bar reversal to identify the reversal. Okay, we've sorted that out. Now, what is a reversal? So this is the overall trend, a downtrend. A reversal would be a pullback, sorry, would be trading this back movement up here. So say price, this is the overall trend when a downtrend, right? Price has moved down all the way to these lows, and then all of a sudden you see a reversal, right? So this bullish candle engulfed this red candle, this bearish candle, then price started to move up. But you're still confident that we're going to continue going down even lower. How do you determine a pullback? Usually it's support and resistance, to be honest. It's usually support and resistance, and it's candlesticks again. So we've discussed inside a bar and how that helps you to add positions. So here you would add a trade at this support, at this resistance area here, which I've marked. So basically this was the first pullback. You wouldn't want to be getting in there. But once price came down to this area here, and then it pulled back to this area here, then once you saw this inside a bar here, then that would confirm a pullback, and then you would enter again. Now be very careful. You don't want to just be jumping in and out, in and out, and in and out, in and out of trades. Remember, pullbacks are to add positions like the inside a bar. They're only supposed to be for you to be adding positions to your trend trading already. Because if you jump in and out, I can assure you, you will get caught, right? Because sometimes, so the best way to determine pullbacks is to look at the support. Usually what tends to happen is that price pulls back to the support area. So say we've marked this area as support, right? This is support. Price pulls back. It usually pulls back to the support area. Now, if it doesn't pull back to the support area, I usually use the 8 moving average and the 89 moving average. And as you can see, we are tightly hugging the 89 moving average on the 4-hourly chart. Throughout this price action series, you've heard me talk a lot about the 89 moving average. That's also a pullback area. So if it doesn't touch the support, the previous support, it usually touches the 89 moving average. So we pull back down again. Price goes down, pulls back up again, goes down. And since this is a terrible example of price moving up to the support area, it usually does. When it doesn't like this, it usually comes to hug the 89 moving average. And so when obviously in cases like this where it's not respecting support, you're gonna have to look at other things. You're gonna have to look at candlestick patterns, right? Inside the bar patterns, 89 moving average to see the pullback, right? These pullbacks here, this pullback. So here would be your opportunities. This is a pullback. Here's a pullback. But you could also use this Fibonacci, right? So so say support and resistance isn't working for that, and the 89 moving average, that's a good option, but sometimes it also doesn't touch that. So Fibonacci is another good pattern, but it's really hard to know when price is gonna fall down again, and that's what makes pullbacks very risky. I'm not a fan personally of pullbacks. I personally am for just getting the entry correct, and once maybe you see inside a bar candlestick pattern and it's touched the 89 moving average, then that can be a confirmation to sell. And so that would be, for example, here. In fact, all of these areas. Let me zoom in so you can see. Here's the first bar that completely engulfs this insider bar. That would be a reversal. Price moved from down here all the way up to this area where it reversed. Did the same here. The second bar was, the insider bar was engulfed, right? Price came down, and then here's the reversal again here. The insider bar, price pulled down, came back up again, engulfed the insider bar, price came down. This was a very ugly insider bar, to be honest. And then price continues down. Another poor example of the insider bar. Price continued to go down. So in all honesty, the insider bar is basically to help you add to your positions. I've talked about pyramiding. And so if you're gonna say you've already entered at the reversal, right? And you want to add to your positions, it would be best for you to look at the 89 moving average with the insider bar. And then if you want, you can add Fibonacci there. You can add Fibonacci to help you, and from there you can enter. Remember, trading pullbacks is very difficult. I will be honest with you. I personally am not a fan of it. I like to just get in once and then hold until the take profit. I'm not for trading pullbacks. It's dangerous because even if price pulls back, you don't know when it's going to fall back. That's the problem with trading pullbacks, is you never know when the price is going to fall back. But that's very different to other markets. So the first thing is you also have to find a currency pair that has pullbacks. A lot of them, they only have pullbacks on the lower time frames, on the 1 hour and the 50. That is dangerous. I'll say it again. If you're going to trade pullbacks and you're going to the lower time frames, that is very dangerous. I would not recommend it, especially pullbacks. If you're going to look for pullbacks, look for a trend, right? Like this one, enter. This is the pound New Zealand that I was talking about this whole time that we've currently entered. Markets have just opened. It's Sunday, and oh gosh, it's 11:30, and we're starting to see a pin bar to the upside. So I prefer to just hold until the end. I'm not good at trading pullbacks. It's not my style, but hey. So if you're gonna trade pullbacks, trade something stable. So for example, look at gold. Trading pullbacks works on stable currencies, not even currencies, stable markets that show consistent uptrends and downtrends. So number one is gold, right? Say you had started to invest in gold and then gold pulled back, right? This is the 89 moving average and the 8 moving average. Price pulled back, you'd buy. And then every pullback, you'd carry on buying until essentially you'd be taken out for break even. Same thing here. As price was touching this 89 moving average, you would be buying, right? Price would pull back, say pull back here, you'd buy. Pull back to this 89, you would buy. Another pullback, you'd buy. Another pullback, you'd buy. Let's take another look at other stable markets to look at it. Look at the S&P 500. It's the S&P 500, I think so. Look at this pullback, right? Since 2018, buy, pullback, you buy again, pullback, you buy, pullback, you buy. Then once you saw a divergence here, divergence, sell divergence is clearly a downtrend forming. So that's when you know essentially that a downtrend is starting. Let's see. Yeah, there's a divergence here. That's where you know you should stop buying. And then ultimately when it starts to pull back up, you sell. Pulls back a bit, you sell. Whenever it has the the bullish candles there, you'd be selling some more. So let's go down to the 4 hour to see what I mean. What I mean essentially is this would be pullback and then you'd sell. This would be the pullback, you'd sell, you'd probably get taken out. But yeah, the takeaway is basically pullbacks are quite dangerous to trade, to be honest. And you'd have to find a pair like this. The US 500, the US 30, gold, a pair that has nice large swings. And you know clearly when an uptrend and you're just buying and buying at the dip, buying at the dip, buying at the dip, buying at the dip. And so that would work on like a gold, a US dollar index. It would work on, let's see the US dollar index. So it would work on, I think Rand pairs, it would work nicely. Yeah, so you see pairs that have these beautiful swings. Those are the kinds that you should be trading pullbacks. But the regular currency pairs, I don't think it's a good idea. I mean, maybe day traders are out there, but day trading is very dangerous as well. So big pullbacks like this are the ones you should be looking out for, right? Big pullbacks like that. But the regular currency pairs, they just don't have that kind of movement. Yeah, I don't think there's anything left to cover here.